It is Thursday, February 12th, 2026. And if you were watching the tickers yesterday, you probably got a little bit of whiplash.
Oh, absolutely. We are deep in that bizarre cycle where, the news is objectively great, but the markets react like someone just stole their lunch money.
It's that good news is bad news thing. And today we're going to unpack why. We've got a jobs report that didn't just beat expectations, it completely dismantled them.
And that has these huge ripple effects for the Federal Reserve, for the AI hardware boom, and believe it or not, for the price of a value meal.
Okay, we have to start with that payroll number. Yesterday's data, 130,000 new jobs in January.
When everyone's expecting, what, 70,000?
70,000, yeah.
Yeah.
And unemployment dropped to 4.3%. I mean, that should be cause for celebration, right? But the Dow, the Nasdaq,
Right.
they rallied for a bit and then just slumped.
Because the bond market saw that number and immediately knew what it meant.
For the Fed?
For the Fed. The traders know that with the labor market running this hot, Jerome Powell has, absolutely zero cover to cut interest rates in June.
Right. They just held steady in late January at that 3.50 to 3.75% range. This data basically cements that for another couple of months.
A June cut was priced in as a near certainty. That's gone now. The conversation has already shifted to July, and even that feels a little shaky.
And it's because of the wage component, isn't it?
That's the kicker. Yeah. Wages grew 0.4% last month. It might sound small, but when you annualize it, it's just enough to keep that inflation needle stuck at somewhat elevated.
So if people are earning more, they're spending more, and prices don't really come down.
Exactly. And if prices don't come down, rates stay up. Simple as that.
And that high rate environment is creating this fascinating split, especially in tech. We're so used to seeing the whole sector move together, but yesterday we saw this huge divergence.
It's all about who's paying for the AI build-out versus who's, selling the shovels in the gold rush.
The physical infrastructure trade.
It is becoming the only game in town. Look at Vertiv Holdings ticker VRT. They jumped over 24% yesterday.
That move was just incredible. And it's not because they launched some new chatbot or software. It's pure physics.
It is. These new AI models generate an insane amount of heat. You can't just blow air on these server racks anymore. It just doesn't work.
Creating a thermal wall.
We are. And Vertiv makes the high-density liquid cooling systems you need to stop your data center from, melting. They basically have a moat around the thermodynamics of AI.
And then on the flip side, you have a giant like Cisco, down 7%.
It's almost the inverse problem. They aren't selling the cooling, they're buying the components to build their networking gear.
And those components are getting expensive.
It's a margin squeeze.
Yep.
They're paying a huge premium for memory chips right now. But if you look globally, that's exactly why South Korea's market is hitting records. Samsung was up 6.4%. They're the ones making those expensive memory chips. So Cisco's cost is Samsung's profit. It's a ruthless food chain.
I want to connect this expensive economy idea back to the consumer.
It really is. We saw that University of Michigan Consumer Sentiment Index hit 57.3, which on paper looks like a recovery.
But when you dig into it,
It's extremely uneven. It's that K-shaped vibe all over again. If you own stocks, if you're holding VRT or Samsung, you feel good. Your portfolio is up. That wealth effect is real.
but for the person who doesn't have a 401k, who's just living off their wages.
For them, sentiment is basically flat. And we saw a really telling signal of this from McDonald's. They beat on earnings, which is great, but you have to look at why they beat.
The extra value meal.
Exactly. They explicitly credited the relaunch of their value menu for driving traffic.
Which tells you everything. We added 130,000 jobs, so people are working, but they're working in an economy where they can only afford the value menu.
They're employed, but they're incredibly budget conscious. You don't usually see that during a booming expansion.
So it really makes you wonder, are we looking at a genuine economic recovery for everyone, or is it just a wealth effect for some, masking a lot of tightness for the average household?
And that's the risk. If sentiment is only going up because asset prices are up, that's a very fragile foundation. If the market turns, that feeling evaporates pretty quickly.
And you're just left with expensive cheeseburgers and high interest rates.
That's the bottom line.
Something to think about, I guess. Thanks for breaking it all down with us.